Okay, you can start your meeting.
All right, so we are live. Good morning, everyone. Welcome to the 2026 Funds Committee meeting. I will call this meeting to order pursuant to City Ordinance 64457. Ms. Ali, can you please take the roll?
Mayor Spencer,
Present.
Roxy Garibaldi,
Present.
Sherman Lane,
Present. So the first thing is just approval of last year's meeting minutes. So I'll entertain a motion to approve last year's meeting minutes.
So moved.
Second.
It's been moved and seconded. Ms. Ali, can you please take the roll?
Mayor Spencer,
Aye.
Roxy Garibaldi,
Aye.
and Sherman Lane.
Aye. Next item is next item is the presentation for me on our Home Mortgage Disclosure Act, or HMDA report. So I will go through that. So I will present my screen now. And then I will take any questions at the end, but if you need to interrupt me for clarity or any questions, we can do that as well. So I always well, can everyone see my screen?
Yes.
Okay, excellent. So I always like to make sure I go over the purpose, but again, what we'll be doing in this report. So I'll be going over the HMDA report, providing some highlights and just some analysis on what the lending landscape has looked like in St. Louis, which is a good barometer of economic activity for the region, given any economic factors and conditions. We will go over our list of city depositories or banking institutions that we have up for approval. We'll get an investment update from our investment partners, approve the broker-dealer list, and then I always like to give an opportunity for the mayor and comptroller to say any words that they have for our banking and investment partners. And then I have a few recognitions for our banking institution, just some words of thanks, and we'll adjourn from there. Okay. Purpose of the meeting, I won't read all this, but the purpose of this meeting, for those who might be joining us for the first time publicly, it's a way that we approve all of our city banking institutions. So we work with 17 plus banking institutions to be able to do the business of the city on the cash management side and investment side. We also have wonderful investment partners. So this is our ability to approve those per city ordinance. And then we also look at the Home Mortgage Disclosure Act data from the banks that we work with. So that data lets us know the lending, again, activity for the city of St. Louis. We're able to put that into context of the economic landscape in St. Louis, and it gives us some indicators as to really growth for this city in the last fiscal year. These are all the applicants for consideration. Put an asterisk by those who are new applicants. So we've worked with First Bank before, but this is their official application, or official time being one of our approved city depositories. So we're happy to add them to the list. So these are our banks. And once we get to the approvals, we'll come back to it. So a couple of things that I will be looking at in this report are presenting on loan volume by loan type. So we want to see how many loans were issued, and we look at mortgages, we look at refinance, and we also look at home improvement loans, and then we also look at small business loans as well. Like to show the maps, which gives an indicator of where lending is happening in the city of St. Louis. And then I also like to look at low and moderate income census tracts to see the comparative averages and volume of lending activity overall for the city of St. Louis, but also looking at those census tracts which may be more difficult to lend in, but also need that investment. And then for each of the banks, we'll see the ratio of originations to applications. And again, originations are just those applications that go on to become full-fledged loan opportunities. So overall, from the HMDA report, I usually like to put the top three. So in terms of volume, we have U.S. Bank, Commerce, and Bank of America. Total overall for the city of St. Louis with our banking institutions. And I stress with our banking institutions because other banks that are not part of the city depository list also, have loan volume in the city. So this is an indicator of loan volume from a majority of the banks in the area, but not necessarily all the banks. But 563 loans issued among the banks, which accounted for 145 million as a total. Overall, this was an 8.2% decrease in loan volume and a 12.7% decrease in the dollar amount. Some economic factors as to why. Well, interest rates have not calmed as quickly as we thought they originally would. Same thing with, refinance rates. So when rates are high, lending becomes a little bit more difficult. Folks are a little bit less likely to buy, especially in a rising cost environment as well. So those are the total loans. When we look at the mortgage volume, so 309 loans issued among our banks for a total of 101 million, which represented a 15% increase in volume from last year, an 11.4% increase in amount. As far as home improvements, so you see the number in the volume, about a 10% decrease in that volume, and an 8.9% increase in the amount. So the amount of the loans that are the amount for the loans actually increased, even though there was a decrease in the volume. And this could be for a number of factors, so I won't speculate on why, but I do know that, or we all know that a big issue that we had in the last year was the fact that a tornado hit St. Louis. So when we think about those improvement loans that were probably issued, one unexpected, but with the severe damage that was caused, that could be a big factor in the increase in the amount. And then refinance, again, always looking at this in terms of what are the rates. So rates have dipped in the last couple of years from their historic highs. Still haven't gone down as much as we would like them to do, but they have dipped. So those who might have had a locked in a higher interest rate maybe 3 or 4 years ago, were able to refinance in those loans. So some more data. Top 5, and this is minimum 20 originations for these banking institutions, but looking at the percentage of loans that actually are applications that actually become loans. So the best of our banks to be able to do this at a high clip, we have Midwest First Bank, our newest applicant, Paramount Enterprise, and Chase. And you can see the percentages there, but we just like to see of those applications that are coming in, how good of a job are our banks doing of getting those approved. So we don't just want applications, but we want to make sure that those are turning into originations as well. And our banks are doing a very solid job of that. And then this is just under 20 originations. And at first, this was all together, and it was all just by loan volume, but wanted to be able to make that distinction because we know that not every bank has to or is going to get 150 applications or 200 loan applications a year. We know that we have our institutions that are lending on a smaller volume level, which is absolutely fine because that is also important. So just wanted to highlight those banks that are that have high origination to or application to origination rates given their size, so under 20 originations. And then also for the over 50, continuing to disaggregate, we have Chase, US Bank, and Bank of America at the top. So LMI approval rates, I started looking at this a couple of years ago. So the overwhelming thought is that lending in low and moderate income areas is a little bit tougher. They require a little bit more support, whether it's first-time homebuyer programs, down payment assistance programs, et cetera. But wanted to also celebrate and highlight those banking institutions and lending institutions that are doing a great job of this and making sure that they're prioritizing lending in these areas. So you'll see the top 5 here. The rate is the rate at which it's the origination rate. So applications to origination. So again, 100% means if they got 7 applications in, 7 originations happen. The differential column, that's the difference from the total or the overall average for all of our 17 banking institutions. So for all 17, we looked at overall what is the application to origination rate for all areas. And this is a differential, so you can see, so that was 50%. So anything over that is great, over the average, and this is where these top 5 were able to rise above that average. So thank you. I'll go to the next one. It's the same. So this is our small business loan activity for the city of St. Louis. I have a couple of highlights there. I know your eyes will be darting all over the screen, but essentially what the highlights do is just direct your attention to the complexity of what we're dealing with in St. Louis, and just knowing that we have large businesses, small businesses, new businesses, more seasoned businesses, but understanding that working with 17 different banks in the city and more is important, because different banks are going to be able to do different things for the many different needs of the small businesses that we have. So there are going to be some banks that say we're going to do a lot of these small business loans, and this is where we're going to prioritize, maybe as opposed to more on the lending side. So yeah, I really do appreciate the relationships that I've been able to build with our bank partners and bank leaders to really understand their business and understand where they want to be strong. And when it comes to, small business loan activity, there's some banks that say, yes, we want to get those larger business loans out there. And then we have some of our banks that say our niche is going to be being able to fund those $5,000 amounts, those $10,000 amount loans, to make sure that some more of our burgeoning small businesses are able to sustain themselves and be successful. All right, so we'll get into some maps, just an ability to provide a visual of, again, where lending is happening in the city from a visual standpoint. So this is home purchase loans by amount in the last year. As you can see, mid and south, there's a lot more activity. So the greener, more activity. Obviously, we know that a tornado hit most of north and northwest, the north side of St. Louis and the west end of St. Louis. And that does have a significant impact on lending volume. So we always want to take into account the economic factors, but this gives us a picture of what the home purchase loan amount was from a visual standpoint for the city. The next one is going to be refinancing. So again, if we're not buying homes, probably not refinancing some as well. But again, talking about the obvious, knowing that we did have a devastating tornado that impacted a lot of the region that is in white. But we are still happy that there is significant volume, even with some of the decreases and also the unfavorability of interest rates in the last few years. And then this is the home improvement loan dollars. And again, if you look, this was actually up by volume, but lower in amount. I would say this picture would be great to compare to next year, and being able to see over the next year, I would say a year removed from the tornado, what the home improvement landscape looks like, what the home purchase and refinance landscape looks like, especially in the areas that were hit hardest by the tornado. That'll give us a great economic barometer of how redevelopment is going in the areas that were hit hardest by the tornado. Oh, and this is just the total loan. So this is all the home loans, improvement, all the other maps put together, essentially. Right. This slide, and I'm going to apologize for this, but I realized as I was reviewing it that this slide was not updated. So I will give the updated numbers. But what this looks at is, since we see the overall loan volume in the HMDA report, I continue to disaggregate that data and say, like, what percentage of the total loan volume, that 560 plus number, are LMI origination. So last year was 37%, and then I compare it to what's the overall. And the purpose for this is just saying, if we're able to lend in the places that are the toughest and need the most development, that is great overall for the city. So I will update these numbers and make sure that I send that out in an email for everyone on this call, and also post it to our site. This is static data. So this is from the last census that was conducted. And one of the reasons when we're talking about home mortgage or home lending, mortgage lending in the city, as well as small business lending, refinance, and home improvement, we do understand that not everyone wants to be a homeowner, but we know that home ownership is a strong indicator of economic improvement and improvement of quality of life, the ability for those to generate and maintain wealth. And so we're looking at, so this is static data from the census, and it's what we're trying to overcome. So what we're trying to, the numbers that we want to see with the next census, we want to see these things improved. So looking at LMI census tract, how many owner occupied units do we currently have, or did we have at the last census? I keep this slide static because I want to make sure that every year we're looking at this until the next census comes out. We know what we're working towards. So we're looking toward increasing these numbers. We want to increase the home ownership rate. We want more folks to buy and own units in the city of St. Louis. That gets more folks that are able to pay property taxes that go to fund essential city functions, as well as our local education. All right. So that is the HMDA report data. I will segue into the scorecard. So I want to thank again all of our banks for participating and sending in their data for our scorecard, our Banking for Economic Equity scorecard. Again, it is an evaluative tool that allows us to open up the conversation and say, this is what the city is committed to on an equity landscape, and it lets us know where our banks are really strong in that and where they'd like to grow. So I always appreciate the conversation. We are not going to go through the entire scorecard on this, but just wanted to make sure I kept that slide up here for you all, for me to make sure I gave you all that recognition. As always, the prior year scorecards are on our website, stltreasurer.org, where you can see those. And then this year's scorecard will be there as well after we have those one-on-one, which I love, one-on-one conversations with each of our banks. Cool. So last couple of things before I end here and open it up for questions. I'm just looking at any recent trends that we've seen. So similar to last year, in the information that our banking institutions have given us outside of just lending, other things that they're doing to make sure that St. Louisans are economically empowered. You can see they're just offering dynamic accounts. So making sure that match savings are available for new savers. We get new savers, people opening up savings accounts all the time at all ages. And we want to make sure that they have access to you all as banking institutions, but also access to that capital. Greg Daly, our collector of revenue, we talk all the time about how at the end of the year, he has long lines of folks who are showing up with cash in their pockets, thousands and thousands of dollars of cash in their pockets to pay their property taxes. And they don't have a bank account or don't want a bank account or don't trust banks. But the work that you all are doing with the products and with the outreach into the community and making sure that you can build that trust, and it happens little by little, and we have to do it inch by inch. But making sure that you all are consistent with that and consistently marketing your products, your services, but really the relationship in community to make sure that we get more folks banked. We know it's safer. We know it provides, again, ease of access to capital and other services that the community needs. So thank you. Okay. Portfolio weighting. So also instituted this a couple of years ago, just showing of our investment portfolio, how much of that is sitting with our local banking institutions. So you can see the percentages here. Last year, we had about 40% of that in terms of that were at the local side. And this is actually flipped, so I'll have to edit this, but non-local and local should actually be flipped. But the percentages are right. So 40% last year was with our local bank institutions and 33% this year. So it is a 7% drop. That drop is mainly because of the spending down of the ARPA funds that were in with our local banking institutions. A lot of that we replaced with other funds, but that's just where the weighting kind of fell right now. But we always like to make sure we're looking at this because we understand that our local banking institutions are investing directly in St. Louis in the St. Louis region. And we want to make sure that as a city, we're doing our part to make sure those funds are available for the lending and for the other business activities that you all do that make St. Louis greater. Okay. Not lastly, but penultimately, I just want to thank really all of our banks, but for those who are working on several of our executive accounts, want to thank you all for making sure that one, we can pay all of our employees every 2 weeks. I know that I truly appreciate that, and I know all of our employees do as well, and working diligently day in and day out to resolve any issues that come up on a biweekly basis with our Treasury Department. So thank you for that. Really want to thank Commerce for the partnership that we have with the My Milestones platform. Happy that we have a high usage among our city employees that are logging in and looking for opportunities to either increase their own financial literacy, to get started on their financial journey, or continue in a positive trend on their financial journey as they seek access to other economic opportunities. And then as it relates to tornado recovery, I know this is all our banks, but I had a few on here that I directly reached out to, or the city directly reached out to, or we were seeing some things that you all were able to do. And if you don't see your name on here, it doesn't mean you're not recognized. So I apologize for that. You can definitely give me a call, but want to just shout out these. So if we're missing something, we tend to, we don't see everything, but thank you for letting us know. And thank you for, again, committing to St. Louis. Lastly, BMO Bank, which has been one of our bank partners for a long time here at the city, is exiting the St. Louis market. But I just wanted to take an opportunity to thank those folks who we worked with, Ron Red and company over at BMO, for bringing solutions to the table all the time, being great partners, being willing to go above and beyond for so many years. So thank you so much, and I wish everyone well in the next phase of their journey that's on that team. All right, so I will stop sharing there and open it up to any questions, and I will start with Mayor Spencer. Any questions, Mayor Spencer?
I don't have any questions today. Thank you for the presentation.
Thank you. Mr. Garavaglia.
I also don't have any questions, but thank you as well.
Okay. All right. So thank you. So then the next item then, I did that pretty quickly. The next item then is just approval of our city depositories. So everyone should have a list of that, but I will entertain a motion to approve our city depositories for fiscal year 27.
So moved.
Second.
Okay, it's been moved in second. I don't know if I can call for previous roll, but let me know if I can't. But I'll call for previous roll. Any objections to previous roll? All right, so it is approved. All right, thank you. I will pass it over to our investment partners for our investment update.
Great, good morning. I'm going to share my screen. If you can bear with me one moment. Can you let me know if you can see that?
Yes.
Okay, fantastic. So we're going to go through, I'm from PFM Asset Management. My name is Gray Lepley. I'm going to go through the actual investment update in terms of what's been going on in the markets, things of that nature, and then also turn it over to some of the other partners to speak to their portion of the report. And then finally, I'm going to ask that we approve the broker-dealer list that's at the back of this report. So to start out, I can get the page to work. There we go. So current market themes. So I just wanted to kind of spend a few minutes talking about what's been going on in the economy recently. Big picture, it's that the economy continues to hold up better than many had expected throughout time, and more recently too. So at the top, you can see we're talking about AI, and while consumers are becoming a little bit more cautious, significant investment in AI has really helped with growth moving forward when we think about what that looks like from a GDP, or gross domestic product, economic growth perspective. When we think about inflation, I'll speak a little bit more to this in a few minutes, inflation may be near the high water mark that we've recently seen because of the geopolitical tensions in the Middle East with Iran. Obviously, we've seen the Strait of Hormuz shut down as a result of the will they, won't they situation going on over there. So that's really been a driver of inflation recently. But of course, we're expecting that, again, we may be near the high water mark there, so that could be positive. I'll also speak about the following in a little bit, but the labor market is in a pretty healthy place. Employment generally remains solid, and I'll talk a little bit further about that. There has been quite a bit of a change if you look at the middle of the page in regards to the Fed. So the Federal Reserve actually has now a new chair, who is Kevin Warsh. Before that, it was Jerome Powell, and he had been chair for many years. And what we've seen most recently is that the Fed has left rates unchanged at that 350 to 375% range. So when we think about where interest rates had been, we had been over 525 at one point, not super far in the distant past here. But more recently, the most recent Fed cut that we saw was in December. We came into 2026 expecting that we would see more cuts as we discussed a few minutes ago, and that has not come to fruition. So that's impacting, of course, what's happening with your portfolios, the yield on those portfolios, and we'll talk about that a little bit more in a minute. With this new leadership at the Fed, Kevin Warsh, there's been a push for providing less forward guidance, that is, less information about what the Fed thinks is going to be happening as they move forward. And that could be really a signal that we're expecting the Fed's movements to depend heavily on any incoming data that is actually that's actually presented. When we think about what the markets have interpreted from that is that they expected that to be somewhat hawkish. So hawkish meaning that the Fed is more focused on inflation. They're going to make sure to fight that inflation as part of the dual mandate of inflation, price stability, as well as full employment. So as a result, Treasury yields have really moved up. And again, we'll talk about that in a few minutes. But from an investment standpoint, we're seeing attractive opportunities in the shorter term fixed income markets where we see valuations can continue to be pretty compelling. And then finally, when we think about some of the investment opportunities that we're utilizing in the portfolios, credit markets remain strong. And what I mean by that is we've continued to see people not be as concerned about risk. So corporate fundamentals remain very strong, and that's been good for the markets in general. But as a result, we've seen these credit spreads continue to be very tight. So the difference you can get from a treasury versus commercial paper, for instance, has been quite tight. And that's been good for overall performance in the portfolio. So summarize on this page, growth remains positive. Inflation appears to be easing to a certain extent. Credit fundamentals are healthy. So there are still risks, of course, including the geopolitical risks that we've seen recently, but we think that the economic backdrop generally has remained constructive. When we go onto this page, this shows where we're thinking that things are heading in terms of negative, neutral, positive. On the negative side right now, we expect that the geopolitical uncertainty with the war in Iran is going to continue to provide supply chain disruptions, especially when it comes to energy products. So think about gasoline, think about oil in general, think about things like urea and other parts that go into fertilizer, for instance. So that has continued to weigh on things. And as a result, we've continued to see inflation, and I'll talk about that in a moment, but inflation be rather high in comparison to where we were prior to this conflict starting. We are seeing the savings rate near record lows, and a lot of that has to do with the fact that people are still spending, but inflation is eating into that spending, right? Because wage growth has not necessarily kept up as strongly as we had wanted it to. So most recently, on last Friday, we got the most recent jobs report at 3.2%. That is where average hourly earnings are currently. That is the lowest since 2021. So while it is generally in line with inflation, it's not higher than inflation, which means that people are not, again, being able to save as much as they would have prior when average hourly earnings was higher than inflation. And as a result of that, third bullet there, you're seeing increasing credit card balances. So that's something that obviously is not a positive for the economy if people are spending on credit or spending debt, going into debt to spend money. It's something that we're going to continue to keep an eye on, especially when it comes to some of the investments that would be impacted by that. At the bottom there, you can see the Hormuz ship traffic that has improved significantly over the past few weeks. It was, much higher, not too long ago, but it has been pretty low from March until about May when we saw the worst of the conflict. In the neutral column, the Fed policy uncertainty, I talked about this, the fact that the Fed doesn't know where to move yet. And the Fed is thinking, well, with regards to what's happening with unemployment, maybe we need to keep rates steady. We need to be supportive of the jobs market. When it comes to inflation, again, Fed Chair Kevin Warsh has said that he wants to make sure that they're fighting inflation if necessary. And speaking of inflation, core inflation, so think about overall inflation picture takes into account all the different basket of goods and services that you and I are spending on a regular basis. Core inflation strips out more volatile components. So volatile components tend to be food and energy prices. And we've seen that recently with the energy spikes, gas prices being much higher, et cetera, because of what's happening in Iran. As a result of that, what we've been focusing on recently is core inflation, trying to get a sense as to whether or not the conflict in Iran is actually shifting into and affecting overall core services inflation. So are we seeing that come into the overall picture and making an impact where it might be a little bit harder to kind of get rid of? That has been modest thus far. So we've not really seen that be, a pipeline that we obviously don't want to have happen. The most recent CPI report came in yesterday at 3.2%. So on a year-over-year basis, that means that prices have increased by 3.2%. The Fed's target is 2%, so we're well above that at this point, but it has eased slightly from last month when it was 3.3%. So again, as I mentioned before, we may be at that high watermark and maybe continuing on a path to seeing more improvement. I talked a little bit about AI investment already, so I'm not going to belabor that point. But then on the positive side, we're continuing to see low layoffs and generally stable unemployment rate. So the jobs market data that we received again on Friday, we saw the unemployment rate go down to 4.1%. A lot of that has to do with the labor force participation rate actually going down. But still, we're still seeing a low hire, low fire environment right now. I mentioned corporate fundamentals are strong. So when you look at what's going on in the stock market and the fact that we're continuing to see all-time highs, that's because people are feeling more comfortable with the corporate fundamentals and willing to take on that risk. And then finally, supportive fiscal policy. So again, the Fed being at 350 to 375 versus the over 5% that we were not too long ago is definitely supportive generally for the markets. So again, if we're in a position where we continue to see lower rates, that will obviously be better for borrowing costs and things of that nature. And we'll see that as it comes. Finally, for this section, I wanted to talk about treasury yields and give you a sense as to where we've been over the past quarter. So to give you your bearings here, the light blue shaded area is the 1-year range of all of these different treasuries across the curve from 3 months to 30 years in terms of yields. So you can see that we've been as low on the 2-year, for instance, below 350, and on the 30-year, we've been over 5% over the past year. But when you look at the other lines, the dotted line is March 31st data. June 30th data is the solid line. So just over the past quarter, you can see that rates have really increased substantially. Why is that? It's what we talked about before. It's because of the fact that the market is expecting that we're going to continue to see potentially even rate hikes as a result of the high inflation that we've seen recently. With that in mind, the market has priced in these potential rate hikes, and therefore yields are higher than they had been 3-6 months ago. Okay, so when we get into the investment manager summary on this page, I wanted to give you a lay of the land in terms of who is investing what. The reserve funds are being managed by PFM Asset Management and Ramirez Asset Management. The 2024 airport bond funds are being managed by Loop and Ramirez, and all other current bond funds are being managed by SWS Capital Management. When it comes to what the city is managing themselves, general operating funds, ARPA funds, as was mentioned earlier, and the RAM settlement proceeds are being managed by the treasurer's office. Going into manager summaries, I'll start with myself since I'm already talking and then hand it over to the other folks on the call here. Who is PFM Asset Management? We are built to serve the public sector. PFM stands for Public Financial Management, and we are dedicated to that sector, specifically public finance, right? So what do? We serve state and local governments like yourselves, like the city, also public pensions, higher education, school districts, et cetera. And a lot of that has to do with really making sure we have a good sense and a good handle on investment codes, any needs that the public sector actually has, which are very different from what, say, someone who is private wealth or is a corporation would have. We have strong performance track record, which we'll talk about in a moment, transparent reporting that we provide all the time, and a commitment to client education, which is through many of our webinars, many of which you can receive CPE credit for if you are so interested. Our solutions include local government investment pools, MOSIP being one of them. MOSIP is the Missouri Securities Investment Program, in which the city is invested. But we also do fixed income investment strategies. So short-term fixed income investment strategies, cash or intermediate as well. And we also have some specialized solutions such as structured products and arbitrage rebate, which are important calculations that can be done on your bond proceeds investments. So in all, we manage approximately $177 billion in public assets. We've had 40 plus years of serving the public sector, and we have over 700 public sector clients. Turning to what we do for the city, on this page you can see the portfolios that we are currently managing, the St. Louis Airport portfolio, the Airport PFC portfolio, and the City General Pool portfolio. As of 3/31, you can see that $216 million being invested there. As of 6/30, it was down slightly to 207 about million. In terms of what's in MOSIP, which I mentioned earlier, is our local government investment pools, where local governments can literally pool their funds together and get a higher rate of return than what they potentially would be able to get by themselves. MOSIP, at the end of March, that was at 495 million, up to 529 million as of 6/30. So overall assets are invested with PFM Asset Management as of 3/31 were 711 million. Now, as of 6/30, 736 million. You can see that broken down here. Just wanted to give you a sense as to what the yields are at this point. So the yield on cost of the overall picture of what we're investing in separately managed accounts at the top there is 3.96. That means that is where we have been able to purchase securities over time for these portfolios. The average market yield, which is in the next column, is 4.14%. Why is there a discrepancy there? It's because the market has gone up, right? We just talked about the fact that yields had gone up from 3/31 to 6/30 pretty substantially. And as a result, we've seen those yields continue to move up at market. So for instance, if we were to reconstitute each of these portfolios, completely create the exact same portfolios today and not have purchased securities over time, they would be yielding at 4.14 versus the 3.96 that they're currently earning. The duration, which is an average duration and is a measure of interest rate risk, is currently 1.45 years, and they're generally invested in a very similar fashion, all three of these portfolios. At the bottom, you can see total return performance. So what is this? This is taking into account not only price moves, but also market moves, and gives you a sense as to what the overall total dollar return is on the portfolios. For the last quarter, you can see that the overall was 54 basis points for each of these three portfolios versus the 53 of the benchmark. But over the past 1 year, it's been about 335 versus the benchmark of 324. And then if you go all the way to the bottom, for this column there, the four, all the way on the right-hand side, you can see that for the 10-year numbers, close to 210, 209 versus the 196. So strong outperformance there, which we are very proud of and hope that you're happy with, and we'll continue to obviously work hard to continue to have that going on. I'll just stop right there and see if there's any questions for me before I turn it over to SWS.
No questions for me. Thank you.
Okay. I will continue on then and share my screen. SWS.
Great, thank you very much. Thank you, Mayor Spencer, Treasurer Lane, and Mr. Garavaglia for allowing us to present. We are SWS Capital Management. It stands for Siebert Williams Shank Capital Management. We are the asset management arm of a diversified financial services company. We specialize in fixed income management for public finance, municipalities, higher education, corporations, and foundations. We manage about 64 million for the city. For about 4 years, we've been partnering with them. We manage about 21 individual accounts for different bond indentures, for airport, for the convention center, for the parking, and for the Park Series. All that money is custody down locally at St. Louis. We work with several trustees and the departments as noted above. Great, you can move on to the next slide because I'll keep it relatively short. These are multiple accounts with different cash flows. They all have different durations and cash flow constraints, but we manage to these accounts all the different benchmarks, and we work to make sure that we maximize returns for all these individuals' clients. So I'll stop there, noting that we have other managers who want to speak. Any questions from the committee?
No questions for me.
Great, thank you.
Thank you.
Okay, Loop Capital Management.
Hi, everyone. Good morning, members of the committee, and for those that are joining on YouTube. My name is George Liu. I am a member of Loop Capital Asset Management. So I am one of your managers of two that manages bond proceeds for the airport account. But a little bit about Loop Capital Asset Management for those that may not be familiar with my firm. Loop Capital Asset Management, we are a U.S. Institutional fixed income manager, where Loop Capital is one of the U.S.'s largest diverse owned investment banking, financial services companies. Loop Capital Asset Management is located in Miami, Florida. We have about 25 employees as last count. Assets under management is just a little bit over 11 billion as of the end of June. We only focus on U.S. fixed income, and so that's where kind of our skill set and interest lay. We generally believe that there's always an opportunity within fixed income markets because there's no such thing as perfect markets. We like to structure our portfolios both from a top down, which is kind of a macro view, and kind of the comments that you've heard already from Ray from PFM. Kind of we share kind of similar macro views around the economy and inflation and direction of the Fed. But we also kind of pair that up with kind of a diverse team of research analysts. So we like to do kind of looking at specific companies, drilling into their financials, and trying to find kind of the diamond in the rough, so to speak, for our clients. We've been around for over 30 years. Many of our relationships, many of our clients, both in the public and private space, have go back 10 plus years. And we were formerly the manager of the year within the fixed income category by Emerging Manager Monthly in 2025. Regards to the account that we manage for the city of St. Louis, it is the airport. It's a 2024 construction account. It started actually, I think, a little bit over 2 years ago, June of 2024. So we've been managing the account for a little bit over 2 years. As of the end of June this year, it was $253 million that we're managing. And it's since inception about 4.27% gross annualized since the time that we've been managing it. But yeah, that's myself and Loop Capital at a really kind of high level. And I'll pause if there's any questions from members of the committee.
Thank you. Nope, no questions for me.
Thank you.
Okay, thanks so much. And on to Ramirez Asset Management.
Yes, hi. My name is Helen Yee, and I'm a portfolio manager at Ramirez Asset Management. I've been with the firm since 2010, and the firm overall has 12 billion firm-wide assets under management, and we're a diversified investment advisor providing fixed income, public equity, and alternative solutions. And the bulk of the 12 billion, about 10 billion, is in fixed income. We are a registered investment advisor within the Ramirez organization. And, one of the oldest and largest diversified financial services firms in the country, which was founded in 1971, and the founder is still working at the company. So Ramirez Asset Management was founded in 2002, and we have about 48 employees. And if you turn to the next page, we are New York based. For the city of St. Louis, since June 24th, 24, we have managed 4 portfolios on behalf of the city of St. Louis, totaling 58.4 billion as of June this year. But this year, right now, because there's been withdrawal about 51 million, and 3 portfolios are funded by the St. Louis Lampert Airport. 2024 bond proceeds totaling 31 million as of June. And the investment portfolios utilizes U.S. Treasuries, high quality commercial paper to provide competitive risk-adjusted returns while emphasizing capital preservation, liquidity, and prudent risk management. One of the portfolios was funded by the General Pool SS Cash, totaling 28.7 million. So that sums it up for Ramirez.
Thanks, Helen. So the last thing we wanted to do was talk about the broker-dealer list for the city. These are the brokers to be approved by the Funds Committee today, if possible. I just wanted to call out a few things. So there's a lot of names here, of course. There's no new names. So these are the exact same brokers that have been provided and approved as of last year. The asterisks are all any minority-owned, woman-owned, or service-disabled, veteran-owned businesses. I just wanted to point that out as well. So there's quite a few of those on this page as well. Any questions on the list?
Thank you, Gray. No questions from me, but I will entertain a motion to approve the broker-dealer list.
So moved.
Second.
It's been moved and seconded. I'll call for previous roll again. Any objection to previous roll? Hearing none, the broker-dealer list is approved.
Thank you. With that, here's our disclaimer slide, but otherwise, if there's any other questions, feel free to let us know, and we look forward to continuing to serve the city.
All right, thank you so much. And thank you all again for being great partners to the city, providing those insights. I know we get them annually here, but we also get them on a quarterly basis, but on demand as well. So I appreciate the relationship that we've had with all of you for quite some time. Next item is new business. We don't have any, so I'll move to any comments or greetings from Mayor Spencer, and then I'll pass it over to you, Mr. Garavaglia, after that. Mayor Spencer.
Thank you. I don't have any comments at this time.
All right, thank you, Mayor. Mr. Garavaglia.
I just wanted to thank you, Mr. Treasurer, our banking partners, our investment partners. Appreciate the professional information and reporting that we received today.
Excellent. Appreciate it. And thank you. All right. Well, that is everything that we have. Again, thank you all. I know we only do this once a year, but I know we do more the other 364 days. So thank you all again, and I will entertain a motion to adjourn.
So moved.
Second.
All right, it's been moved and seconded. I'm going to call for previous roll once more. Any objection to previous roll? All right, hearing none, we are adjourned. Thank you, everyone. Have a great rest of your week.
Thank you.
Thank you.
Yeah.